I think the street has factored in a number of up to 1% contraction, but there is some expectation that you'll see numbers even worse than that. No one's, I think, for even a moment expecting that those numbers will look positive. Certainly not at the level that you saw the September number come in at 1.9%. Negative is what is everyone's factored in, but how bad is it going to be is the big question. Let's take it across to begin with to Ajay Sharma, who's got a heads up on what those IIP numbers could look like.
Good morning, George. George, you're right actually. 0.7% is what ET Now poll stands. If you talk to dealers on the street, they are talking at even worse numbers of -4 to -5%. And if you look at how the markets are behaving right now, Nifty has given up all its gains. It opened above 4900 in the morning, while rest of Asia trades in the green. Nifty is actually down, and we are just moments away from the October IIP being released. So there could be or may not be some kind of a negative surprise, but definitely nobody takes away the fact that the data will be very critical compared to 1.9% positive data in September. Yes, there would be elements of mining, manufacturing and electricity which are expected to be weak and be weighing on the October IIP, but also there's a base effect at play which is very critical. October 2010 we saw over 11% growth, and the positive growth as far as IIP is concerned, which shot up from above 6%. This time round, that high base effect would also be contributing. Also, a lot of economists and strategists are telling us that the kind of data which is released for the month of October will set pace of how the policy stance of RBI will be panning out, and going ahead also, on 14th we are expecting inflation numbers to come out, then advanced tax numbers would be coming out, and then looking at all the three important critical factors, RBI will be declaring its stance and how the policy could shape up. So very critical as far as this data is concerned, because first time in 2 years almost we are seeing a data of sub 0%, which is negative growth coming in for IIP.
All right, Ajay, thanks very much for taking us through what those numbers could look like. So there you have it, 0.7% contraction is what the ET Now poll suggests. And remember, October's really been a terrible month if you look at it pretty from every parameter. For one, like Ajay mentioned, there is going to be the base effect that's going to play on this October's numbers. October 2010, you saw a number of 10.8%. You are going to see those numbers work against that 10.8% number. Also, car sales in the month of October this year have been terrible. You saw Maruti see its sales contract drop by actually 52%, in large part driven by the strike that they had at the Manesar and Gurgaon plants. But you also had Hyundai Motors, which saw a 5% contraction in sales, and even the others like Tata Motors and some of the other big guys like Mahindra and Mahindra saw about 10%. Tata Motors saw about 3% roughly growth in sales in the month of October. So on the car sales front, it's also been bad. Again, core infrastructure output was also pretty bad in the month of October. So all of these factors together do suggest that those numbers could look really bad. The majority of economists that we've polled believe that the number will come in the negative. But we've got one economist with us here in the studio, Madan Sabnavis, who believes that the number could be marginally positive. Madan, if you could just take us through why you believe that 0.65% is what you're looking at.
Yeah, actually, George, I think there's very little difference between a negative number and a marginally positive number. So when we were looking at something like 0.65%, this is actually based on certain statistical modeling and based on the other kind of information which we have available. But as I was saying, I don't really see much difference between a negative number and the 0.65% number which we have been looking at. But the important thing is that this is the first month of the so-called busy season, and it's really going to set the tone for the rest of the second half of the year, because October, November, December is typically the time when consumer spending increases, and this is something which provides the backward linkages to the other sectors of the industry. Now, this probably may not be visible in the month of October, and as you rightly pointed out, the high base year effect is going to come into play, which is going to sort of keep these numbers very subdued. And but I think if you look at the future months of things like November, December, and given the fact that the Kharif harvest has been very good, we could expect a lot of rural spending to spill over for industrial products, which in turn will provide a kind of boost. But just remember one thing, that the government of India still is talking of overall GDP growth in the region of 7.5%, with a negative downside of say 7.25%. And if we have to attain this number of 7.25%, it's imperative that industry grows by around 7% for the entire year. And the first half shows something like 5.4%, which means that there has to be a pickup, otherwise our entire calculations will go amiss.
Sure. Madan, I think, would you say that the bigger worry really is that October typically is the month when you see, festival spending. And in a month when festival spending is at its highest, you're talking about a number that's likely going to come into the negative space. So would you say that's the bigger worry, which in turn is reflective of what the remaining 5 months could look like?
So definitely it's a worry because it's the first month and we also had Diwali, which came in the month of October. So that's normally the time when people spend. So there was a feeling that this time there might have been a diversion of spending more into things like gold and jewelry, because with gold prices going up, rather than in consumer goods. So there could be a certain kind of a downplay of the industrial growth numbers with money going into alternative investments.
So let's just take a moment to, focus our attention on the markets and how they're possibly factoring the kind of numbers that we're expecting. So we were gravitating towards that 4,900 level, and now you can see we are managing to see a bit of a pullback, but 4,862 is really what we're clinging on to. So not too much happening by way of movement for the benchmark indices. The Sensex also just lower by about 2 points, 16,216. And you have a slew of stocks which are dragging the markets down. You've got an SBI. A lot of the banks are limping in today's session. So an SBI, you've got a Kotak Mahindra Bank, an ICICI Bank, not looking particularly strong. And cement has also been a bit of a drag on the markets. But let's focus more on the kind of numbers that we're expecting this time around. Abhijit Chakrabarti, the Senior Vice President of Institutional Equities at Fortune Financial Services, also joins into this discussion. Abhijit, thanks very much for being with us. Let's firstly talk about the kind of numbers that you're expecting in terms of IIP, as well as how much of importance you would give to this kind of a number in terms of the overall growth for the Indian economy.
Hi, good morning. We have been seeing a slowdown in the overall IIP numbers over the last couple of months and the last quarter itself. And the last month itself we were at 1.9%, and the expectation for this month is that, for the month of October, is that we could be going into the negative territory. How much it could be -1% to -3-4%. That we will come to know very shortly. But very clearly, what is evident is that there are pressure points in the economy, and there are certain sectors which are dragging down this growth. Mining is one sector which has seen year till date a negative growth. Capital goods is the other segment which has seen significant deceleration in space of growth. Electricity, which saw a major growth in the last month on a YOY basis, could once again come under pressure in the month of October. And as you were mentioning, that consumer spending has not been to the mark in the month of October. So these things could possibly lead us to a scenario where we can see a significant deceleration in IIP. But the other thing is that market is already expecting that, so there might not be a very sharp correction. What it's going to lead to is perhaps the assumptions for the overall GDP growth and the manufacturing sector growth for the economy for the current year could be revised downwards formally. There could be downgrades coming both for economic projections as well as the earnings growth projections. And I feel that this government's assumption of 7.25 to 7.75 of GDP growth for the current year looks to be erring on the positive optimist side. I think we could be ending the year with more like 6.9 to 7% growth. If we were to achieve 7.25, 7.5% kind of a GDP growth this year, there has to be a significant pickup in the manufacturing sector, because agriculture is growing at 3.2, 3.5%, and we don't see any significant increase over there. Services is growing at 9% and above, so that is maintaining its trend line. What has fallen off is the manufacturing, the IIP. And for that to pick up, a lot of things have to come in place. The slowdown in the IIP and the manufacturing space we are seeing, especially in the capital, in some segments like capital goods, electricity, mining, etc., are more to do with the high interest costs in the economy, government policies and reform measures related to electricity or mining. These issues I don't think are going to resolve in a month's time. So it would be wrong to assume that we could be having a 7.5% kind of a GDP. We could be more closer to 7% or below that for the year.
All right. Abhijit, we'll come back to you in a moment. We've got Mr. Seshadri of Bank of India also joining us on the show. Mr. Seshadri, we've been talking now for some time about the growth outlook for the Indian economy, the credit offtake that banks like yours are seeing. Would you say that the situation now is pretty bad, that it could get worse before it gets any better?
I wouldn't know whether it would get still worse, but it has not seen any positive development in the past couple of months, and I don't see that changing. Although some sort of a pause in interest rate might see some positive sentiments, if not actually growth. But definitely on the whole, the entire indicators, in fact, do not see some sort of a growth coming in the next even 3 to 6 months' time also.
Sure. And, Madan, just bringing it back to you, in the breakup of the IIP numbers that we've seen in past months, electricity has been one bright spot. Last month we saw it grow by 9%. This time the forecast is at 6.5%. But given all the coal shortages and other related issues that a lot of electricity producers have been facing, would you say that even a 6.5% number somewhere looks a little optimistic?
I think 6.5 is quite okay, because I think we are still importing quite a bit of coal, and given the fact that we've had a good monsoon, our hydel production has also been good. So I think on the whole, electricity production has been something which has been driving the overall IIP numbers, given the fact that mining has been in a negative territory for most of this year.
Sure. Prudent, then also for a second then to just bring up the kind of movement that we're seeing across the Asian indices, because given that most of the Asian markets are in an upswing, we seem to be underperforming and significantly at that. So in anticipation to the IIP numbers, you are seeing pretty much a bit of nervousness which is coming on the streets, and there's lots of factors which we are attributing to this negative number of 0.7 when it comes to the IIP numbers. But you've got the Asian markets which this time around are doing fairly well. You've got the Nikkei, which is inching up in early morning trade. You have the Kospi, which is also bouncing back. You have strong data also which came out from the US, which is largely attributing to this kind of a number. But, just wanted to take it back to you, Abhijit, with respect to the kind of data that we're working with, the kind of hazy global environment, domestically things aren't looking very rosy either. As of now, just to reiterate what George said, would you expect, if you put yourself in the shoes of a company, would you expect that the worst will, be priced in, or that the worst is yet to come, or that it's over and then that things will get better?
No, I think from the company's perspective, the issues which are plaguing for instance, if we just see the earnings growth in the second quarter, the top line growth has been quite decent at 20% growth. So I think the underlying demand in the economy has not faltered, and that is the key strength to look forward to. But what has impacted the earnings in the last quarter was the currency fluctuations and the high interest costs, which is impacting your project cost as well and putting the projects on hold. So these are the things which have affected the overall corporate performance in the last quarter. And unless those things are resolved, a lot of policy issues have to be resolved. Government has to clear a lot of issues, both in mining, electricity, as well as in the capital goods and infrastructure space, before the capex can start. And the interest rates, the moment they start coming down, we are going to see a pickup in the corporate capex announcements, which can be a big positive sentiment for the markets as a whole. But these issues, as I said earlier, these issues are not going to be getting resolved in a month's time or so. Currency, for instance, has been a big pressure point for the corporate earnings in the last quarter, and we don't think it is going to reverse very soon. It might go to first 54 and 55, and then perhaps retrace back to 50.
Right, Abhijit, we'll come back to you in a moment. There you have it. The number is at a minus 5.1%. This is against a growth of 1.9% in the month of September. So disastrous is what those numbers are. Remember, most of the economists we spoke to believe that on a worst case basis you'd see minus 4.5%. What you have in front of you showing on your screen is minus 5.1%. We did mention that this is in also large part because of a very high base effect that you are seeing. In October 2010 you had a number of 11.4%. But remember, October hasn't at all been a good month in 2011 for the Indian economy. We did mention a number of factors. Infrastructure output in the month of October, we did mention, was up 0.1% against 2.3% in September. So that has been that was an indicator that the number would be bad. We also did mention the fact that car sales were very, very poor in the month of October. Also, issues like the fact that the festival season really didn't do anything for these numbers. Minus 5.1%. Madan, I'm going to ask you to react first to those numbers.
I think this has come as quite a shocker actually, but 5.1 is probably the last thing that we did expect, and I think we would really have to revise our overall projections for the Indian economy for the rest of the year, because 5.1 really brings us down, and I think cumulatively the picture should also be in the region of around 5 or maybe sub 5%, and overall getting hold of the 7% number for the entire year will be quite a challenge going ahead, considering that October has, which typically should have been providing the buoyancy for the busy season, has not really been seen. So I think a lot will now have to also depend upon what the Reserve Bank of India does, and given the fact that inflation seems moving downwards, we could really expect a pause on the part of RBI to sort of revive investment and consumer spending based on leverage.
we have managed to get a hold of the internal numbers as well. So October manufacturing has come in at a dismal minus 6%. Remember, this is what we were expecting, minus 0.9%. This is versus a growth of 2.1% in September. Electricity, though, has managed to remain quite buoyant, and this is largely on expected lines. So while the ET Now poll was throwing up a number of 6.5%, it's come in at 5.6%. But what is also coming in as a major shocker is the mining growth. In fact, degrowth, minus 5% is what we were factoring in, and minus 7.2% versus minus 5.7% is what the mining number has come in. But a very shocking number, Abhijit, minus 5.1%. What do you make of it?
Yeah, I think it is more on the disastrous side, and that is what we were expecting. You know, that the pressure points in the economy like mining and manufacturing, electricity, there is a lot of reform policy which is required by the government, and the overall interest rate scenario needs to be benign before there could be a pickup in these things. And as I have been reiterating, that forget about the base effect. Base effect can make things look good and bad any year. But if you look at the absolute value of this index, whether it is manufacturing, mining, capital goods, intermediate goods, there has been no particular traction in the last 9-10 months of this year, and that is worrisome. Overall, there is a slowdown in the gross capital formation. The government is not able to spend more to kickstart the economy because of its compulsions from fiscal deficit side. Interest rates are against the corporates, and the policy reforms, the less said the better. So I think that this kind of a slowdown is going to continue in this couple of pressure point sectors of the economy, and we can see further downgrades.
Right. Abhijit, I'm also going to ask you to give us a take on what the outlook for capital goods stocks are, because the October numbers suggest that the capital goods sector has contracted by 25% against 6.8% in September. So again, the fact that October has been disastrous, what would you say the outlook would be?
Yeah, this 25%, I'm just hearing it from you, this 25% contraction in capital goods is absolutely shocking. This is, we have been continuously negative on the electricity sector as whole and the capital goods, because we are not seeing any kind of a corporate capex happening, as well as the fact that, you know, the BTG segment, in the power segment, capital goods segment, are not seeing any intake of orders, whether it is L&T or BHEL or any other large capital goods companies you talk about. There is no significant order flow. And on top of that, slow capex execution is also another issue, that in spite of having a good order book, the execution is not happening because of labor issues, policy issues, or high interest rates. So I think this particular number, although the capital goods companies have corrected a lot, this particular kind of a data is going to bring them under further pressure.
Sure, of course, what you can see on your screen, this is the worst data that you see, the biggest contraction in 28 months. But Madan, just coming to you, consumer goods growth, that's been one bright spot as far as the IIP numbers have gone in the past. For the current month, we're seeing a contraction of 0.3% against a growth of 3.5%, that too in a festival month. How would you react to that?
No, I think this is a major worry, because if you look at overall industrial growth and the way transmission mechanism works, everything starts basically from consumer goods, in particular consumer durable goods, because we need to see a buoyant demand for these goods in order to provide backward linkages to your capital goods sector, basic goods and intermediate goods. And any kind of a slowdown, especially at the time of the busy season, would obviously mean that it will have long-term implications for the rest of the sectors, because consumer durables demand slowing down in one particular month is probably a one-shot affair. But the kind of backward linkages which necessitate greater production of the other kinds of goods, especially basic and capital goods, would also mean that there would be a time lag of 3 to 4 months before any kind of revival could take place.